Hello again. Today we're going to take a look at the second exercise in Chapter 2 and work our way through the balance sheet changes that Brie Manufacturing is going to have in January. So what this exercise is intended to help you practice is understanding the relationships between the accounts as various transactions happen. We're only concerned in this chapter with the balance sheet. It will be Chapter 3 before we put both the balance sheet and the income statement transactions together and see what the whole shoot and match looks like. So let's get started. What I have done so far is start the exercise by simply copying the current assets, fixed assets, and so on off Brie Manufacturing that you were given in the chapter. Now I'm using the North American style, and in most cases that's what I will use. You're free to use the European or the international format for the balance sheet. Just make sure that you're consistent. Don't use a mix off the two, in other words. Okay, so we have everything laid out here, and I have with me a copy of the transactions that are occurring. One of the things that's interesting that makes things balance nicely in the balance sheet is the concept of dual reporting. Okay, so we use a dual accounting method, which means that for every transaction at least two accounts will be affected, and that way we get to balance the things off. You'll see what I mean, I hope, as we go through this question. Okay, let's start. So in January 2012, so this is the month after this particular statement, so this is as of December 31st, 2011. So we're interested here in the first months of activities that have carried on in the business. Number one is anticipation of the new season starting in February. Brie bought 42,000 euros off inventory on credit. Okay, so for each one of these, what you need to think about are the accounts that are affected by this transaction. Okay, now in this case, we are increasing our inventory, so obviously the inventory account is affected. So let's add 42,000 to the existing inventory. What these numbers give us are the existing levels at the start of January. So we have to continue with those starting balances, if you think of them that way, in each of these accounts. Now if you buy inventory on credit, what does that mean? What kind of account is that? Okay, first of all, we're buying merchandise. We're going to be selling this merchandise at some point. So that sounds an awful lot like a trade payable, or what we call mostly here in Canada an accounts payable. So accounts payable is a current liability. We have 37,000 already, so we add 42 to that. So you can see right away that when we use this dual type of recording, that we're keeping the balance sheet in balance at all times. Because if we add 42 to this balance and 42 to this balance, the full balance sheet will still balance at each time. So be careful as you go through it, and you won't make very many mistakes, if any. Next one, we borrowed 25,000 euros from the bank and used 15,000 off the 25 to buy a van. So first of all, we borrowed 25,000 from the bank. If we're going to use it for a term piece of equipment like a van, then that comes down here under term loan. We already owe the bank 50,000, and we're going to add another 25,000 to that. we have 19,000 worth of motor vans, and we bought another one, so for 15,000. Okay, so now we're still 10,000 out of balancing, and you must make an assumption here that the extra 10,000 that was borrowed just was received as cash. So we're going to increase cash by 10,000. Number 3, the owner of the company withdrew 5,000 euros for personal use. Okay, so 5,000, first of all, is cash, is an account, so we're going to reduce cash by 5. And whenever the owner of a business withdraws money from that business for personal uses, it comes directly out of equity. Okay, it's not an expense. It just is a balance sheet thing, and we reduce our cash by 5, and we're going to reduce our equity by 5 as well. Number 4 received 6,000 euros from accounts receivables. Now what that means is that the person that, or company that owed you money, or owed Brie Manufacturing money because they bought something and didn't have the cash to pay for it, they're now paying some of that cash. So first of all, the 6,000 is going to increase the level of cash by $6,000. It goes up, positive. And we have accounts receivables. And accounts receivables will now go down by 6,000. Okay, notice in this case, the transaction just involved current assets, current asset levels. So if one goes up, another one has to go down in order for the balance to stay in place. Number 5, paid 8,000 on payables. Okay, so again, paid in cash, 8,000, cash goes down, and payables also go down by 8,000 because we are able to pay some of those off. And finally, the company took out a mortgage, bought some land and buildings, and typically it's a long-term loan, and it's typically referred to as a mortgage. It's a special document that's particularly used for buying land. Okay. So we don't have any mortgages to start off with, so we need to add mortgages down here. And in essence, it's starting at 0 because we didn't have them before, and we're adding 65,000 to that. Okay, we bought land for 15,000, so land will go up 15,000 euros, and there was a building on the land, or buildings on the land at least, and that went up by 50,000. All right, so if we have taken care of all parts of the transactions, remember at least 2 accounts are affected by any separate transaction. A transaction is typically just a buy and sell agreement between the different businesses. Okay, so the next step is we want to add all of these up. And just to save room, I'm going to kind of add them and slot them in where I want them at the same time. Okay, so we are going to just add up each of these to find out what the balance in each account is as of the end of January 2012. All right, so we have to, if some accounts are not affected, now in this case I think we've dealt with all the accounts. If an account has not been affected by a transaction, then the amount that existed on December 31st will just transfer over to the other side. So here we are at and now we have Brie Manufacturing, and the balance sheet. I'm going to use short form here. I don't want you to use short form though. I'm restricted by this size of this board. Balance sheet on January 31st, 2012. Okay, so in this case, if we add this all across, we'll have cash of $15,000. We have accounts receivables of 12. Inventories equal 65,000 for a total on current assets of 92. If we add this around, we'll have land worth now 60. Buildings and equipment 80. Motor vans 34. For a total of fixed assets equal to 174 euros, and a total asset of 266,000 euros. So we continue down with current liabilities. Accounts payable now 71,000. The term loan is 75,000, and the $65,000 or 1,000 euros mortgage. So this subtotals to 211. Add equity of, which has dropped to 55, for a total liabilities and equity of 266 euros. And it balances. This is a fairly straightforward, very short question. However, if you can understand the transactions and how we do this, then you won't have any trouble with a more complicated or longer problem in the future. Thank you, and good luck with the next assignment.